Hello, everyone. Great seeing, well, I guess it's great seeing all your names. It's not as like I'm seeing you face to face, but thank you so much for joining me tonight. For those of you who don't know me, my name is Michael Petraka. I'm the owner and operator of HJP Financial Group, and you came to a fantastic webinar. Tonight, I'm going to go a little bit of everywhere. We're going to talk about government, politics, the economy, the oil market, and really what that means for someone's portfolio. A little different than I've done in the past. We're going to take a deep dive into kind of the current models and what we're doing with everything that's going out in the market. Naturally, if you have any questions, you'll see at the bottom of the Zoom screen a little raise your hand feature. Feel free to click on that. We can certainly have a back and forth. Just know at the end of the webinar tonight, I'm going to always leave time for a Q&A. So hope you enjoy it, and let's get started. So what we're looking at right here is just a snapshot of the S&P 500 roughly over the last 30 years. So to go over just briefly recent history, if we could go back to March here of 2020, that has kind of been the beginning, I would say, of a new phase in this markets. So if you put this chart into three groups, we'll call it kind of this 2000 to 2010 phase, where that was riddled with two of the worst downturns since the Great Depression. Markets were relatively flat for an entire decade. Then we had a kind of slow and steady march up. So this was a period of time between 2010 and 2020 where we had interest rates very low, the economy growing, but growing at 1.5%, 2%, and nothing terribly crazy happening during that time period. Markets were really good over that time as well. And then COVID hit. So COVID came out of nowhere. Markets dropped 34% in a matter of 6 weeks, fastest decline in history. We take out a big financial bazooka in terms of the government and just riddled money everywhere, kind of helicopter money, as they would say, and more or less backstopped the whole financial system. When markets realized the amount of money being thrown around, they pretty much got shot out of a cannon in the other direction. So markets screamed back up till 2022, and that's where we had the recession that never came. So this was a period of time where it looked like the economy was slowing down, inflation was gumming up the work, we had higher interest rates. So markets, which are trying to predict where the economy is going, it says we think we're going to be in a recession in a year to 18 months, and started to sell off, and markets dropped 25%. Problem was the recession never came. So that also paired up with kind of the beginning of this AI trade. And so from 2022 to today, one of the best bull markets in the history of this country, a period of time where everything has really been about AI. Where's it going? Everyone is really excited. This has some similarities to the tech bubble of 2000. So if you think late 90s, the personal computer was new, the internet was new, it was email. This is going to be a whole new world. Everything's going to change. And so there was a lot of euphoria, confidence. And the hard part with new technologies is knowing what's prudent, what's not. So as a company, should we put a lot of time and money behind this? Should we wait until other people do it and then just copy them? So it's a lot of hit and miss. It's a lot of going down path and realizing, oop, crap, we got to go back the other way. But as we sit here today, as an investor in this market, this has been rather wonderful. The last few years, markets around the world have kind of marched straight up, and really all types of investments have done pretty well. Bonds done okay the last few years. The gold market, commodities, stocks, international, big, small. This has really been a wonderful time to own what we would call risky assets. So as we sit here today, just this most recent swings, this was last year during the tariffs, and then this was the beginning of the Iran war, Iran conflict that's playing out right now. So year to date, markets are up 8-9%. Not too shabby for half a year's work. So let's take a little deeper dive into that. Now, one of the most interesting things playing out right now is all those stocks, like I just showed you, have gone to all-time highs and some would say to, even more expensive levels. The stock market has actually gotten cheaper over the last 6 months. So you might say, how is this possible? Let me give you a quick little example. So let's say you have a rental property and the rent's 10 grand. That's the earnings. And in today's market, you could sell it for 100 grand. So rent's 10 grand times 10 times is your multiple. So you could sell it for that 100 grand. So what's played out recently? Well, let me take one step back. There's two reasons that 100 grand value can go up. One is, let's say rent grows from 10 grand to 12 grand, in which case that's a 20% bump. So we have the same 10 times multiplier. Now that property worth 100 grand is worth 120 grand. So because the earnings have gone up, the value has gone up. The reverse can also play out. Let's say earnings have stayed put. My rent is still 10 grand, but when you go to check to see what other people are willing to buy it from you, you hear that somebody's willing to spend 120. Well, that means the multiple is now 12 because my rent stayed the same, but the multiple went up to 12, hence 10 grand times 12 is 120 grand. So the market can really go up for one of those two reasons or both. So recently, like I said, the stock market, although it has gone up in price, it actually got cheaper. And the reason for that is earnings have been shot out of a cannon. So here's kind of earnings over time, and here's some projections going forward. So for 2026, earnings projections are for the S&P 500, 500 largest companies in the United States, or public companies, is projected to grow at 24%. That is incredible growth in earnings. So if you cut that in half, that's 12%. So this is why, even though the stock market's gone up 9, because earnings have gone up faster than the price, that means the overall market's gotten a little cheaper. So this is why, as I go back a few slides, there's your multiplier. It's right now paying about 20 times earnings. So if you went back 6 months ago, a year ago, it was really 21, 22 and change was kind of the highest of recent history. So the market's actually gotten a little less expensive, which is a good thing. Really, historically, or at least over the last 30 years, that multiplier's been around 17. So you think, well, why are we trading at 20? Because there's optimism. There's a lot of confidence in this market. We don't know where AI is going to be, but it could kind of change everything and improve companies left and right. Time will tell. Now, going forward, let's say come next year, our multiple stays at 20. And let's say this holds true, that earnings grow 17%. Well, if we go back to my example, if our multiple stays the same and earnings go up 17%, prices or stocks should go up 17%. Now, what's always very hard and why anyone that you listen to on a webinar or see on TV that says, stocks are going to be here in 6 months, it's noise. Because although they may be able to have a good idea of where they think earnings is going to be, the hard part, of course, is the multiple. That's based on confidence, psychology, how we all feel about the markets and the direction things are going. So this is why this is a chart saying, well, if our multiples here around 20, what does the next year look like? It's all over the place. Now, the multiple gets more effective at telling you probably future rates of returns in the longer time horizon. I would argue 5, even that's kind of okay. 10 years, 15 years, it's a really good indicator of a range of rates of return. Now, obviously, the higher the multiple, the more expensive markets are. So the fact that we're trading at 20 probably means that future returns for markets will be a little bit muted compared to the last 10, 15 years. Which again, markets for the last 15 years have given you like 15 plus rate of return. So things tend to ebb and flow. So the fact that we had an above average rate of return, historically, stocks, let's say over the last 50, 60, 70 years have been around 10, 11%. So you probably, like I said, if we had above average around 15, you're probably getting a little bit below average over the next 5, 10, 15 years. Now, as I've been mentioning, kind of the biggest thing we have going is AI spending. But the hard part, as I always kind of check the markets and the kind of the news that's going on today. This is a pretty important day. So we had the Federal Reserve just came out. They left interest rates the same. We had oil spike up 5, 6, 7% because of flare-ups going on in Iran. We had two of the biggest companies in the world, Meta and Microsoft, report their earnings today. You're seeing trends of the semiconductor space, all the chip manufacturers have done gangbusters wonderful, start to sell off. There's a whole bunch of headlines. Which one's important? And not only which ones are important, but what's the proper weight you're supposed to put on them? This is where I get a lot of people come to me and just be flat out terrified of the future of markets. I want to get out. I hear you. The news there is a tremendous amount of stuff going on, a lot of it negative. So I fully get it. But over the last year, every time something negative played out, hey, the tariffs, oil, whatever it may be, eventually the quarterly earnings come out and they're going gangbusters. So it's really telling you there's AI right now, and then there's everything else. And to drive that point home, what we're looking here on the left side of this slide, we're really talking about a handful of companies. Alphabet, which is Google, Amazon, Meta or Facebook, Microsoft, Oracle, ChatGPT, Anthropic. A few companies are spending incredible sums of money. So on this slide, it's just going over these five and saying, well, let's go back to 2019, which wasn't that long ago. Their combined spending on capital expenditures, so factories, databases, chips, whatever it may be, was around $71 billion. We have now 10x'd the amount of spending associated with capital expenditures in 7 years. These companies are spending $750 billion. Now, what one company's spending is another company's revenue. And these are investments. It's spiking up the economy. It's stimulating stuff. So hence why all this stuff can be going on. Oil's spiking up. Consumer confidence in the tank. Political drama. But if these companies are spending like this, it all goes back to that slide I showed you on earnings. Earnings are going to go up 24%. It's really hard for the stock market to go down if earnings are going up 24%. Now, normally I'd say the $1 million question, but it's not a $1 million question. It's not a $1 billion question. It's a multi-trillion-dollar question of, well, where are we in terms of this AI spending? Very good question. Now, this is what is projected out over the next few years. Meta just came out recently. Google came out and clarified that, hey, we're going to spend even more next year, and the spigot is still going. So it's very hard to tell, as people say, are we in a bubble? Yeah, this level of spending long term is not sustainable. Google just came out with their earnings. This is the first time they've had negative earnings in their entire public career. This is, these big companies are having to start to borrow money, start to use leverage. Their cash flow is going negative. So, no, this is not sustainable. But that doesn't mean the party doesn't go on for years. It's very hard to tell. So, to take it back to a few slides ago, this was the tech bubble. So the question is, are we in 1997? Are we in 1999? It's very hard to tell. So, if you're trying to decide if you want to scream for the exit, just know markets can go up another 150% from here and take years to continue to go up. Do not know the answer to that question. But for now, the party goes on. Projections or estimates for next year, continuing to spend. And like I said, if earnings are coming up double-digit growth, it's just hard for the market to go down. Now, one of the things we need to keep in mind is it used to be a lot easier to stay diversified in the S&P 500 because you think, hey, I'm in 500 different companies. That's got to be pretty good diversification. Now, just know the S&P 500 is what's called a market weighted index, which means the bigger you are as a company, the bigger you're getting weighted in the index. So this is showing you the top 10 companies over different decades. So the 80s, 90s, 2000s, obviously so on and so forth. Now, two things to keep in mind. One, as you can kind of tell, in the first 4 decades we're looking at here, it was much more diversified, meaning those top 10 names only represented about 20% of the index. So it's pretty spread out, all different sectors, every different parts of the market, geographically. Um, since tech has just been on a tear for the last 20 years or so, these big behemoths, the magnificent so-called seven, again, these Metas, Facebook, Googles, the Amazons, the Apples of the world, we are now looking at an S&P 500 that the top 10 names are 40% of the index. That means the other 490 names are just getting squeezed into that last 60%. On top of that, they're turning into kind of a one trick pony. So as kind of we look at these realities, we say, well, what is part of the AI trade? NVIDIA, absolutely. Apple, not as much as others, but without a doubt, part of the AI trade. So as we're looking at this AI, 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 AI. So we got 9 out of the 10 that if the AI trade goes down, we're going to feel it because again, it's not as diversified as it once was. Again, not a reason to panic, and that's been a good thing. Markets have been screaming up, so the AI trade has been kind of wonderful. So don't, it's not always bad. It's just understanding of where are the risks. So as we change gear here a little bit, we're going to touch upon inflation. So here we are in 2022 when inflation was kind of going crazy. Everything was becoming expensive. Inflation was peaking up 9, 10% before the government had to step in and raise rates at a really high clip. Has steadily come down until more or less recently. So it started to spike again as we entered into the Iran war situation. It's a combination, obviously, the Iran war and all this spending on AI. So as these companies are spending like crazy, that's making all the other spending prices go up. As these companies are trying to hire every plumber, electrician, contractor, well, that means the typical home buyers have to pay more for their labor because so much is piling into the infrastructure around AI. So it's a combination of that as well as, we're an economy that runs on oil. It's oil and tech. As much as we might want to, be a little bit greener or whatever the case may be, for now in 2026, oil is a humongous part of our reality. So as oil has gone from 50 to $60 a barrel, right now I think it's around 90. I think it was as high as 120. So that's like a 50% increase from just 6 months ago. So that is these green lines you're seeing here in terms of oil spiking. Now, oil's come down, and now it looks like it's going back up as this conflict continues. If this conversation or webinar was a few weeks ago, and we saw the oil come down back into the low 70s, I would have said this inflation was probably a one-time pop. We'll probably get back down to trend, which is, let's call it somewhere between 2.5% and 3%, because you would see this green line drop off. Now, the longer oil stays higher, the less that holds true, the more it will seep into other aspects of the economy and puts inflation higher and sustainably higher. If you think about it, if you're a company, all right, maybe it's a month or two that oil prices and gas prices spiked and your profits are going to go down because you're gasoline prices have gone up, and you say, well, all right, that was a crappy month or two, but that's behind us, and we'll just keep the prices as is because we just saw it as a one-time expense. But the more it's a sustainably higher, then they can't just eat it. Then they typically have to pass it on to the consumer in the form of higher prices. Once they do that, they typically don't lower the prices. So that makes that what was probably a short-term inflationary pop become a little bit more sustainable. This is why, and we're going to talk about interest rates and the Fed, although they decided to keep interest rates the same for now, that the Federal Reserve is a board. So I think it's 12 different people who vote. More than most of the time, they all agree or to do X or agree to do Y. You're starting to see a kind of split of like, hey, we need to raise interest rates to deal with this inflation, and half are kind of staying the course. So it's a conflicting time right now. And it's hard because it's like, tell me where the Iran conflict's going to be in 3 months, and I tell you what to do with interest rates. So war is very naturally unpredictable. So what we're looking at here is the Consumer Confidence Index. So throughout the year, people get surveyed. How do you feel about the economy, the stock market, the direction the country's going? And I would argue it's kind of broken right now. So if you look back at the last 50 years, it's kind of a predictable situation. If we're in a recession and the stock market's down and people are losing their job, people's mood goes down. That's just realistic. But so again, when you look back at all the times that are really negative, it's typically something horrible's played out. So the 2008 financial crisis, this was when we all thought Greece was going to go under and pull down the rest of the Euros with us. Here's COVID. Here's 2022 with inflation was 10%. But we're also down here right now at kind of some of the worst levels we've ever seen. Well, unemployment's at low fours, stock market's at all-time highs. GDP's doing okay. Why are people in such a bad mood? Doesn't really make any sense. You have to dig into the details a little bit more. And so remember, this is just surveying random people around the country. Well, a phrase, kind of the talking heads on TV will throw around the term K-shaped recovery. So, all right, we have an economy. The economy obviously is not equal for everyone. So as we walk through this slide on the top right, we're looking at everyone's households, either by kind of 20th percentile. So 20 to 40, 40 to 60, 60 to 80, and then the top 20% of earners. So we're comparing income versus spending. So what do we see here? All right, if you're in the top 20%, which the majority of people on this call are in the top 20%, really you own stocks, you own some stocks, and you own a house, you're kind of in the top 20%. We have a reality where life is good. We're bringing in, say, 51%, we're spending 38%, which means we have positive cash flow, we get to enjoy life, spend a little bit more, things are kind of wonderful. So again, that's 20% of the individuals. And then we have 20%, kind of the next group, it's a push. They're kind of dollar in, dollar out, living paycheck to paycheck. This is where you see the headlines of like, I make 200 grand and I'm barely getting by. That's kind of these realities. And then everyone else is kind of in a negative cash flow predicament. Because again, oil prices up, food prices up, rent prices up, energy prices up, electric bills are up. So 80% of this country is in a reality where they're breaking even or a painful negative situation. So this kind of drives the point home on the slide right, or the section right below it. Well, what's happened to people's net worth over the last 6 or 7 years, kind of since COVID? Well, here's the top 20%. Here's the bottom 80%. So yes, you got a little bit better, but so has cost, and hence why they kind of feel like they're struggling. The bottom 20, the top 20%, this is as good as it gets. You're seeing your IRAs, your 401ks, your home values, your second properties, everything's kind of gone gangbusters up. So, as I'm sitting with some individuals with beautiful sums of money, and they say, oh my God, I just filled up your gas tank and it was, $62. And I'm like, look at your report. You made 400 grand over the last 12 months. And oh yeah, I forgot. Again, you're not seeing this on a day to day. You see egg prices and gas prices. But top 20%, this is wonderful. So hence the K-shaped. They're the top 20%. The other 80%, this has been a little bit painful. Now, part of this is just a reality is what's playing out as a country. So on the left side, and this is going back over a little over the last 50 years, here's, if we have a company and we say, all right, well, what do the employees get in terms of compensation or cut of the revenue of the business? So we're looking at levels here around 67%. That's kind of consistently dropped over time. So as companies make money, the portion that's going towards the employees has constantly gotten squeezed. The portion that has gone towards corporate profits, aka the shareholders, have consistently gone up. So who wins as shareholders? Owners of stocks. Who own the stock? The top 20%. Kind of creates a little bit of a winner take all system. This is where, and this is why, or at least my own interpretation or opinion, why is things so contentious? The Reds, the Blues, my state, your state, and all this. It's just the haves and the have-nots have gotten a little bit further and further apart. So, this is where you're getting, again, consumer confidence index, people saying this is kind of just as bad of a reality as the 2008 financial crisis. 2008 financial crisis, stocks lost 57%, unemployment was at 10%. The whole financial system was on the verge of collapsing. We had to do huge government bailouts out. Like, obviously the worst I've seen in my lifetime, or anyone who wasn't around since the Great Depression would say that. And yet people feel the same way today. So, there's a lot of frustration out there right now. This is the government's finances. So, I work with individuals and I help them manage their budget, try and save and plan for the future. So let's try and interpret the government's finances as if you were an individual. Excuse me. So right now, we are spending around 7.4 trillion a year. Good chunk of change. We're not bringing in nearly as much, and hence we're running a deficit of close to $2 trillion a year, or 25%. So that's like a couple coming to me, and I say, well, what is your income? Say, oh, we're bringing in about 75 grand. I'm like, okay, great. Well, what are you spending? Oh, we spend 100 grand. You and I both know that's not sustainable. That might work for a year. Something maybe freakishly came up or like a big expense came up, but that is not a sustainable thing over time. So we have to borrow this money. Now, on the bottom here, you're comparing the amount that you're borrowing versus the size of your economy. Now, a pretty unhealthy sign is if what you are borrowing or what your debt is compared to the size of your economy. As the debt becomes bigger than the size of the economy, it becomes too big to handle, and that's where things start to fall apart a little bit. That's more or less where we are today. And here we are in terms of projections going forward, where it's a slow and steady getting worse. Well, why is it going to get worse? Well, can we cut spending? All right, let's take a look. So as we look at this 7.4 trillion, can you cut the interest payments? No, you got to pay your bills. The bondholders want their interest. So you can't cut that. Touching Medicaid, Medicare, and Social Security in a big, meaningful way. Yes, I can, a little smidge here, a little smidge there, but you're not really doing too much. Those are the so-called untouchables, or what we would call political suicide. So the odds of them touching those in a meaningful way, I would put it slim to none. You're probably going to get voted out of office real quick, considering the biggest generation going is the baby boomers. So what do those three programs help right now is baby boomers. So I don't see them slashing it. On top of them not slashing it, we actually added a standard deduction for people 65 and older of an additional 12 grand for married filing joint to help offset some of those costs. So we're going not only in the opposite direction, but we're going up in the opposite direction faster. So we're not touching any of those. We have other mandatory expenses coming at 12%. You don't typically cut defense. So everything that they're trying to really do in a big way is coming out of this 13%, a relatively small piece of the pie. So in my opinion, we have a runaway train. We have a deficit and a debt that are not going to slow down. Okay. Well, is that a problem today? No. We could borrow at 4.5% for a 10-year government bond. That's not bad. That's historically very average. So it's not a problem today. It wasn't a problem 10 years ago. Probably won't be a problem in a year. It's hard to tell when the deficit really becomes a problem. Some people will point to your 2032, 2034 in that range, because that's when Social Security trust fund runs dry, the Medicare trust fund runs dry, and the baby boomers are going to get into their late 70s, early 80s, and typically have a lot of medical expenses, so drain those social programs a lot more. That could be it. I have no idea. No one does. The reality could be in 5 years, it could be in 50 years. We have a lot going for us. We are the number one world power. As much as you hear other countries, no one's even close. China was thought to be coming close, but they went through COVID rather poorly from an economic standpoint. They have a lot of real estate issues. Another way to put it too is if you're a startup company in Sweden right now, are you going to go to Silicon Valley over in California to try and raise money and grow your business? Or would you go to Shanghai? I think 10 times out of 10, you're going to Silicon Valley. Now, that doesn't mean we don't have our problems, but capital comes here. We have loosely the rule of law here. We have wonderful natural resources. We have two huge, oceans kind of protecting us. We have a lot going for us. And typically you need a strong number two to knock us down. I just don't see it in the foreseeable future. So I think we as a country will get a pass probably longer than we should in terms of how high our debt is going to get before we get our comeuppings. But life is very unpredictable when it comes to that type of reality. Now, what I just showed you was a scary slide. We're almost $40 trillion in debt, $2 trillion deficits. We got this bubble that could possibly burst in AI. There's a lot of stuff that can go wrong. Now, some people's instincts is, I'm really afraid I'm putting the money under the mattress. The problem there, at least this go around, is I think that the movie line is the call is coming from in the house. The problem is the US dollar. The problem is our debt. So all the typical safe havens you would use in the past might be the worst place to put it going forward. So like if what inflation is, it's the value of your currency slowly getting diluted. If you had $500,000 and you were ready to buy that house in northern New Jersey in 2019, and you went to go buy it today because you just slipped into a coma and you woke up and you're like, oh, let me go get it. That house now costs 850 grand. If you wanted to buy the S&P 500 in 2019 with that same 500 grand and you want to buy it today, it's doubled. When you have inflation, typically you want to get anywhere other than cash. That's just the reality. Cash is a good short-term emergency. Long-term, it just gets eroded. A lot of you have heard me say in the last 100 years, the value of the dollar has lost about 97% of its value. And as the country continues to borrow and run deficits, you either pay for deficits in one of two ways. You print the money, so when you return it to the individual in the future, it's with diluted money, or you raise taxes. I don't think we're great at raising taxes. It's typically the more painful one, the one that gets you voted out of office. So, all right, if you're sitting there and you're nervous about markets, where you are, what I recommend is to have the understanding of, all right, I'm really scared. What do I do? Your goal is to have your defensive model. You're like, I don't like what I'm seeing. I'm going to my defensive mode. That's not sitting in cash. That really means, yes, you're going to lower some stock exposure, lower some of your little bit more risky investments. But let's say someone's a moderate investor, which I would say is somewhere between 50% and 75% stocks. Go to your Alamo, go to your defensive line, go to your 50% and get crazy diversified. So what does crazy diversified mean? So what we're looking at here is rates of returns for all different types of investments that you might have in your portfolio. We have the bond market, real estate, what we would call high yield or junk bonds, large company US stocks, cash, small companies, Europe and Japan, commodities, and emerging markets. I want you to look at kind of two lines. This line up top and the second one below it. So in all of my portfolios, we probably have close to 12 or 13 types of investments. So what do we need? Yes, we know in bad times the whole portfolio is going to go down. But we don't take all your money out in one shot. We take a little bit out each year, might be 4 or 5% of the portfolio. So what do we need? Something to be doing okay in a given year. So this top two, whatever, we don't know what it's going to be, hence you're going to diversify, but we know typically 20% of the portfolio is probably going to be fine no matter what shakes out. No one on this call is 100% in stocks. So if we see this second line here, 17, 7, 19, 32, 1, 25, flat, 28. So what this is telling you, there's typically always something in your account that's fine to touch as you need to take a distribution in retirement. So yes, you're going to go defensive, but that doesn't mean in cash. It means to my defensive, diversified, anchored portfolio. And you stay that till you feel comfortable. So this way, if markets continue to march up, like, hey, yes, I'm enjoying the march up, not as much as I did before, but that's okay because I want to be a little bit more defensive. But if markets start to turn, you don't panic because I'm prepared for that. I'm already in my defensive portfolio. I know there's going to be something in the portfolio that's doing well. So if I need money, I'm fine. And everything else, if you're just holding broad exposure to, the US stock market or the European stock market or whatever it may be, they'll go down. And 100% of the time in history, they've come back to all-time highs. So we should be patient, diversified, and we don't panic. Now we switch gears a little bit. We're talking about the stock side. Now there's the bond side of the equation. Like I just mentioned, the Federal Reserve came out today and they kept interest rates at their current rate. So this line here is just going sideways. That's okay. That's a good deal. That means, if we're earning CDs, money markets, they'll probably continue close to the same pace that's going on right now. The question is, going back to what I said about inflation before, if inflation gets sticky, they're going to have to raise interest rates. This is really tough on people in their 20s, 30s trying to build their lives. All right, I want to buy a house. Great. It's at all-time high and interest rates are 6.5% to 7%. That's tough. If you're trying to open a business and you need a loan from the bank, it's going to cost you 7, 8, 9, 10%. All right, that's a little tough, at least compared to 5 years ago. Now, something you always have to keep in the back of your mind as kind of CD conservative bond investors who are looking for rates of return, what's my rate of return after inflation? You don't eat dollars. You take those dollars and buy food. You take those dollars and buy a shelter, either rent or home. So the fact that you made 5% or 6% or 3% is only half the story. What does that mean in terms of what I'm able to buy with it? What's my purchasing power? So here we are as of the end of the last quarter. The 10-year government bond is yielding around 4.5%. Inflation is close to 3%. So you're actually earned about 1.5%. That's not horrible. And depending on your situation, it has its appropriate spot in your portfolio, in your life. But always think of inflation when you think of rate of return. Now, we've gone through about a 15-year period where international stocks have underperformed rather dramatically to US stocks, partially because those big tech names, you're starting to see a shift, which is these gray bars where international is doing much better. US stocks are trading at 20 times earnings. International is trading at international develop, Europe and Japan, close to 14, 15. Emerging markets are trading at 10, and their earnings are growing at a really fantastic pace. Emerging markets really look enticing at these levels. So we probably have a period of time where international stocks do better. They did better last year. They've done better so far year to date. We'll see if the trend continues. Again, it's always a good slide to go over. Just remember, really, however you're invested, all stocks, all bonds, a mix of the two, in any one year, you can have pain. But at a 5, 10, 20-year rolling period for the last 75 years, if you were in some sort of mix, let's say a 60-40 mix, you haven't lost money in any 5-year period, including the 2008 financial crisis, if you just stayed calm, let alone if you took advantage of it. Meaning you increase your exposure to stocks as stocks were getting cheaper. But if you just stayed the course, you haven't lost money in any 5-year period. So as markets start to turn, if they do tomorrow or whenever it does happen, stay calm, stay disciplined. Markets kind of reward you over time, or at least they always have been. This is just to drive the point home, especially if we have more inflation over the next 20 years than we did for the last 20 years. It's just comparing, let's call it cash or CDs, corporate bonds, small company stocks, large company stocks. Something many of you have heard me say, you want your money in different buckets. So bucket one, short term, your checking, savings. I don't care that it's sitting in cash because it's liquid, it's safe. I need to touch it, in the next 3-6 months. You have a middle bucket. All right, this is a project I might need money in a year. I'm going to do a renovation. I'm going to buy a car. CDs, beautiful. That should be 1 to 2 year money. The bulk of your money, you want to have a healthy mix of things that give you a rate of return above inflation. The way you would want to think about it is you start every year down 3% because of inflation. So we need the bulk of our net worth, if we're trying to build net worth over time, is rates of returns above inflation. So we need to be targeting 6, 7, 8% rate of return for my long-term money, not for the money you need the next year or two. Again, everything has its place. Everything is a tool. But the bulk of it, even if stocks are scary, it's going to reward you over time. That's just the reality. And I think especially as AI becomes a bigger and bigger reality, if you're a company that has 100,000 employees and AI is getting better and better and able to do tier 1 white collar positions, tier 2, tier 3. All right, maybe in 3 years to get the same level of revenue you're getting today, you can slash 20,000 jobs. You get 20,000, salaries you don't have to spend. So your, expenses go down, your net income is going up, you're more profitable, and shareholders win more. So again, stocks long term. I also like rental real estate. That's great too. But these are the things that owning your own small business, rental real estate, the stock market, gold has given it to you over time, rates of returns above inflation.